So it seems like everybody's talking about Chinese stocks right now because the Chinese stock market is essentially in a bear market, with the Shanghai Composite Index down over 20% year to date at the time of this recording, but also down well over 25% from their 52-week high. And because many Chinese stocks are also listed on US exchanges, with several big name stocks down huge from their 52-week highs, including Alibaba down over 30%, Tencent down over 40%, and JD.com down over 50%, it's natural that a lot of viewers are asking me if right now is the right time to buy Chinese stocks. So in this video, I'm going to give my opinion on why Chinese stocks are dropping, if I think things will turn around anytime soon, and if I plan on buying any Chinese stocks myself. So sit back, relax, make sure you're subscribed to the channel, and let's get started. What's up, everybody? My name is Ale and welcome to my world of stocks. I just want to say really quick, I do not currently own any Chinese stocks except for a small speculative position in a company called NIO. I made a full video on their company and their stock. You can find that up here in the description or at the end of this video on a clickable card. But I am definitely interested in and tracking very closely those big name Chinese stocks that I mentioned at the beginning, and also some other smaller Chinese companies and their stocks as well. But if I had to just go with one Chinese stock that I am really bullish on right now in the long term, that would be Alibaba. That's a stock that I'm really interested in, ticker symbol BABA, and I do plan on picking them up sometime soon, but we'll talk more about that at the end of this video. But let's start by looking at why Chinese stocks are down right now and why China's markets are struggling. I think a lot of this really has to do with China's economy slowing down, but then it really got escalated by the whole trade fight or trade war, whatever you want to call it, with the United States of America. And that even led to the Chinese yuan weakening versus the US dollar. But to be fair, when looking at China's economy, there's no doubt that it's slowing down, but that doesn't mean that it's not still growing by a massive amount every single year. In fact, China's GDP has grown over the past few decades to all-time highs, and they now rank as the second largest economy in the world, only behind the United States. And that's really due to several different things, including a growing population, both in the quality of the workforce and just in the sheer number, with over 1.4 billion people, making China the most populous country in the world, with almost a fifth of the world's population. But it's also due to things like smarter use of capital, assets, resources, and investments, astronomical growth in exports, better technology, better infrastructure, and to be honest, a more capitalistic approach to their economy, or at least a bit more capitalistic in nature now than it has been in the past. But when looking at their GDP annual growth rate, it's slowed down considerably and has been in a downward trend for close to a decade, having dropped from around 6.8% in Q1 of this year, now down to 6.5% in Q3, even missing estimates of 6.6%. But to be fair again, they are still growing by over 6%, whereas the United States is only growing at around 3%, but the trend is at least upward for the US. And looking at the emerging economy of something like India, that really beats both of the United States and China, with over 8% growth, and is still trending upward. And I think many analysts would agree that a lot of this has to do with an aging population of China versus a much younger growing population of India. When you look at the population of the two countries, they're the two most populous countries in the world. I think China right now has around 1.4 billion people. India probably has around 1.3 billion. But when you look at the population pyramids of each country, by the way, if you don't know what population pyramids are, these are something that I used a lot when I was back in college when I was getting my master's degree. But population pyramids tell you, they kind of give you the makeup of the population, and it's kind of broken down by, I'm sorry, I just hit the mic, but it's broken down not just by gender, but it's also broken down by age. And so when we look at the population pyramid of China, you can see that China's population is much larger in the middle-aged to aging sections of the pyramid versus India, where India's population starts out pretty large at the younger ages and gradually shrinks as you go up in the pyramid and as you go go up in age. So this means that India has a much younger population that can potentially replace a lot of those aging workers and keep the economy growing and accelerating at a much faster rate than something like China. But to be fair, China does have a pretty large kind of middle-aged population. They are seeing a rise in their middle class, and that's a good thing if you want to grow your consumer economy, which is definitely something that China wants to do. They've been heavily reliant on their export economy. They would like to also have a consumer economy in China itself to kind of balance things out. But they are no doubt dealing with the consequences of an aging population, which usually does slow down growth. And some of this probably has to do with that one-child policy of China that you've probably heard about in the past. That really helped them in the past develop a skilled and productive workforce, but now they're kind of paying the price for it with much less of a younger population that can replace these aging workers. But regardless, GDP is not really a concern that I have for China. Yes, their economy is slowing down, but I also think that it's ignorant to expect them to keep climbing at astronomical rates forever when they are already dominating by so much. Now, we used India in a prior example, so let's use them again. But now let's take a look at GDP total, altogether GDP. India comes in with a GDP at around 2.6 trillion, which is not bad, right? Well, China eclipses that number at over $12.2 trillion, so almost $10 trillion more than India. So even if we just take the 6.5% growth rate of that 12.2 trillion, that alone comes in at around $800 billion. That means that even though China's growth is slowing down, its growth rate alone brings in around 1/3 of India's total GDP for the entire year. In other words, China's economy is an absolute monster, and being the second largest economy in the world, I don't necessarily think it's fair to say that we shouldn't invest in Chinese stocks just because their economy is slowing down. But of course, that leads us to this whole trade war issue with the United States, or this trade fight, or whatever you want to call it. Now, if you take a slowing down economy and then you add on top of that, which by the way is heavily reliant on exports, we'll talk about that in a second, but then you add on top of that a trade fight with the biggest economy in the world, yeah, you're gonna have some fear creeping into the markets and investors are gonna get spooked. Speaking of which, China is the world leader in exports by a very wide margin, and they've seen tremendous exporting growth in the past, but has since been a little flat. You can kind of see that on this chart here. It's kind of up and down in the past few years. So you can now see why a trade fight between the US and China would absolutely scare investors. Now, when looking at the trade fight, what really kind of started all of that? Well, there's really two reasons that I see, and one is the very clear trade imbalance between the US and China, and then the other reason is that China was accused of stealing intellectual property from foreign companies, including companies from the United States. Now, in 2017, the US imported more goods from China than any other country in the world, and it equated to more than $500 billion worth of goods, while China, on the other hand, only imported around $130 billion worth from the United States. So that's a pretty big difference. And then when looking at the whole IP theft thing, that really has to do with Chinese companies taking intellectual properties from these foreign companies, including the US, in exchange for access to China's markets, which have pretty much been kind of a closed market for China. Now, that's clearly a violation of World Trade Organization rules, and it's been going on for many years. China, of course, denies any of that. They deny that they've done anything wrong. But a lot of these Chinese companies that were taking these intellectual properties from US companies, a lot of them are actually owned by, socialist China. Now, I know that there's some really strong opinions on this issue. There's a lot of different ways you can look at this issue, a lot of different ways you can calculate some of these numbers. Some people, would side with the US, some would side with China, some are kind of in the middle, some don't know how to feel. I'm not really giving my opinion on that. I'm just saying that regardless of how you feel, the United States is basically trying to put pressure on China on a global kind of stage, and they're basically calling them out, and they are implementing tariffs, which are basically taxes on Chinese imports coming into the United States. Now, at the moment, these trade tariffs are highly controversial. they don't just affect the United States and China, they affect other countries as well. There's kind of a back and forth going with other countries also. So it's just a little bit of a mess right now. Some people would side with the United States and say that right now the United States is in a little bit of a position of power because their economy is actually growing, while the Chinese economy is kind of slowing down, and Chinese markets are also in decline, whereas the U.S. markets are kind of going up. Although we've had some pretty bad volatility right now in the market. But anyway, some would side with the U.S., saying that right now is the time to put pressure on China and get a more fair kind of trade deal, while others would argue that this not only hurts the US economy, the Chinese economy, but also the global economy. In fact, the International Monetary Fund cut the US growth forecast for 2019 from 2.7% to 2.5% and noted that higher trade barriers would disrupt global supply chains. And then others feel that it's not as big of a deal as everyone's making it out to be, and countries have trade disputes all the times, and trade tariffs usually play a big role in that. But regardless of personal opinions, the US so far has implemented tariffs on about $250 billion worth of Chinese imports. That includes a 10% tax on $200 billion worth that would actually increase to 25% if a deal is not reached by the end of the year. Not to mention that Bloomberg also reported that the US is prepping to add tariffs on the remainder of Chinese imports if trade talks at the upcoming G20 summit go badly, which would equate to around double the amount. In case you don't already know, President Trump and President Xi will be meeting at the summit, and I believe it's taking place at the end of this month on November 30. So obviously higher tariffs on Chinese imports would really hurt China pretty badly, I think. In fact, when you look at Bloomberg again, their economists estimate that a 25% tax on all Chinese imports could bring down China's 2019 GDP growth by as much as 1.5 percentage points. That's a pretty big deal when you consider the fact that China's economy is already slowing down and their stocks are already declining. I would expect their Chinese stocks to continue to hurt, at least in the short term, if that happens. So then the obvious conclusion that we can come to is that if we want Chinese stocks to recover and start performing well again, we probably need to figure out this whole trade dispute. Now, I guess there is a possibility that these Chinese stocks could just kind of bottom out on their own just because they're being oversold at this point, or maybe at some point, and then just kind of start to recover on their own. But man, I just see that, I kind of find that hard to believe. If this trade dispute continues going on, we know how markets react to this kind of like fear and uncertainty. I really think that Chinese stocks would continue to hurt if we do not get these trade disputes resolved. Now, at this point, it's anyone's guess how the G20 summit will go, but on the bright side, Trump did tweet out on November 1st saying, "Just had a long and very good conversation with President Xi of China. We talked about many subjects with a heavy emphasis on trade. Those discussions are moving along nicely, with meetings being scheduled at the G20 summit in Argentina." And I've also seen some reports of both the US and China preparing some terms, preparing some proposals for this G20 summit. But I've also seen some kind of contradicting reports as well, saying that the complete opposite is happening and they're just really not ready to come to any kind of agreement. So I can't really confirm one way or the other. But my personal opinion is that I do think there will be some progress made at this summit, because we already showed evidence suggesting that China's economy is going to continue to take damage if this trade dispute continues. So I think China would definitely want to get this resolved. And then when looking at the US isn't really benefiting from this too much either, because a lot of US companies are actually lowering fourth quarter guidance, and a lot of them are actually mentioning this whole trade war as a reason for why they're lowering guidance. And also, when you look at the US stock market, it's actually been pretty shaky lately too, in case you haven't noticed. And we've had a major correction, and some of that probably has to do with the whole trade war. So I think that if Trump wants to get reelected in 2020, he's been taking so much credit for the stock market. I think he's probably going to want to get this trade dispute resolved by 2020 so he can try to get reelected. You probably don't want to go into those elections with a trade war going on with China. It's probably going to make you look pretty bad. So I do think that this gets resolved sooner than what most people are expecting. I know Jack Ma from the CEO of Alibaba said that it could take like 20 years. I just completely disagree with him. I do not think it's going to take that long. I really do think that some progress will be made and this gets resolved sooner than people are expecting. Ultimately, I think both sides are going to have to give a little bit, but I think the US really stands to benefit the most out of this, because if China increases the amount of goods that they buy from the US, then I think that that's going to create a lot of jobs for the US. It's going to look as a really good positive. Having a more balanced trade is definitely going to be a positive for the US. And then it might also lead to more US investment in China's kind of closed economy as well, which would also be a good thing. We're seeing some of that right now already. I know BMW was allowed to buy their like partner Chinese company. They were allowed to buy it, which is something that you wouldn't really expect. Tesla's building their factory in Shanghai, is it? Tesla's building a factory out there. So we are kind of seeing some more access. It's probably not enough to please President Trump, but if we kind of see some more of that, that could definitely be a good thing, I think, for the US. Now, as far as what I plan to do, I am really interested in Chinese stocks. Now, I know that there's a whole kind of safety concern with Chinese stocks. I have a future video that I'm working on that I'm going to get out to you guys that's going to go over VIEs and that kind of whole structural thing and if it's safe to invest in Chinese stocks. But I'm really interested in Chinese stocks because I think it gives growth investors a huge amount of opportunity, because you can essentially pick up like US clone companies at the start of their companies, right? Like you often hear the Tesla of China, the Facebook of China, the eBay of China, the Amazon of China, right? Like these kind of younger companies that are growing at really high rates. And so there's kind of an opportunity there to pick up some growth stocks. Whereas here in the US, you're kind of seeing a lot of these traditional growth companies kind of slowing down a little bit. So I see a lot of potential in China, and I'm definitely interested in Chinese stocks. Now, I mentioned that Alibaba is a stock that I'm really interested in, and I really want to pick them up soon. They have a forward PE of like 21, I think, and they're down already massively. So I do think that they're a bit oversold. But at the same time, I kind of feel like Chinese stocks are going to continue to drop. So I kind of have two different strategies that I could go with. Now, one strategy would be to just start buying right now and just keep buying as it continues to drop. I know a lot of investors are doing that. A lot of YouTubers are talking about their strategy, kind of doing something similar with like Alibaba, JD.com, different stocks like that. I'm considering doing that because I'm more of a long-term investor. I believe in dollar cost averaging. So that kind of strategy fits in with something like a bear market. It fits in perfectly because then you really start to pick up stocks heavily as they drop in price. Believe it or not, I'm actually really happy when stocks drop in price. I've been getting a lot of heat lately because of all the volatility that's been happening in the market right now. So I've talked about a lot of different stocks, and I've just been getting a lot of hate comments saying, oh, you talked about this stock and it dropped, 15%. It's like, okay, 20%, whatever. It doesn't matter how much it dropped. If stocks that I'm really interested in are dropping, that's a good thing for me. That makes me happy. So sometimes I'm reading these hate comments, and I think it's hilarious because they're super angry and they're looking at me as if I'm some kind of idiot or something. And I'm just smiling because every time that I see stocks dropping in price, that makes me really happy. It means I can pick up more shares. I mean, that's the whole point of dollar cost averaging. I don't know if, these people might not understand that, but, long term is not just 1 month. It's not just 2 months. It's looking at more than a decade out. So, let's talk in a decade from now and let's talk about where these prices are at and if it was a smart investment, what I chose to do. But either way, it's my choice to invest in whatever stocks I want. So I don't know what the problem is. But anyway, I just went off on a rant, so I apologize for that. Getting back on track, I could do that strategy with Alibaba and just think long term and just keep picking up Alibaba as it continues to drop. Or I could wait until the G20 summit and see if there's any kind of progress made there, because I really do think that that's going to provide us with a lot of information, and it's going to help us kind of prepare an outlook for the future and see if this whole trade dispute will get resolved sooner rather than later. So to be honest with you, I haven't decided yet. I haven't decided if I want to pick up Alibaba yet. It could be tomorrow, and I might just on impulse, I might just pick up a few shares of Alibaba. But what I can tell you is that when I start buying these Chinese stocks, I'm going to start extremely small, like very, very small, very tiny positions, and just add to them as they continue to drop. But I really do feel like I want to wait for the G20 summit. The only exception to that might be Alibaba. I might start with Alibaba, but as far as like the vast majority of other Chinese stocks that I'm tracking and interested in, I will definitely wait for those. I'll definitely wait until at least the G20 summit and probably even more to kind of see where this whole trade dispute goes and then kind of go from there. Okay guys, but that's all I have for you. I hope that you enjoyed the video. If you did, please consider supporting the channel. It really helps a lot when you guys hit the like button. I know you might think that it's not a big deal. And to be honest, every time that I watch YouTube videos, I'm not so great at it either. A lot of times I forget to hit the like button, but one thing that I've realized is that by having a YouTube channel myself, I realize how much it helps to hit the like button. So now every time that I watch YouTubers that I actually like, I always hit the like button now because I just realized how much it actually really does help them. So if you did like this video, please hit the like button. And please leave a nice comment if you'd like to talk about anything. If you disagree with me, you can also leave a comment and we can have a conversation about it. And are you planning on picking up any Chinese stocks? I would love to hear what you guys think. I have some really smart subscribers and I really value all of your guys' comments and opinions. So please leave a comment down below. I'd love to read it. I'd love to respond and have a conversation with you. And I got more videos on the way, guys. Please hang in there. Thank you so much for watching. I hope you're all having a great time right now, and I hope that you're all being safe in the stock market. I know there's a lot of volatility. I know there's a lot of fear going around about a possible crash anytime soon. So just be careful, and I think having a long-term strategy will really help take away a lot of that kind of uncertainty and fear and a lot of the risk, right? Having a long-term strategy, it eliminates a lot of the risk. So just be careful. Try to think long-term if possible, at least if you're a beginner. And anyway, just be smart. Thank you so much for watching. I hope you all have a wonderful, beautiful day and that you take care. Bye-bye.